In the early 2000s, the world was experiencing a significant shift in the economy. The dot-com bubble, which had driven the stock market to new heights, was about to burst. In 2001, the stock market suffered a major crash that had far-reaching consequences, affecting investors, businesses, and the economy as a whole. This video will explore the causes and consequences of the 2001 stock market crash. Background. To understand the 2001 stock market crash, it is important to look at the dot-com bubble, which was a period of massive speculation and investment in internet-based companies. Between 1995 and 2000, the value of internet stocks skyrocketed, with some companies experiencing growth of over 1,000% in just a few months. Investors poured money into these companies, hoping to cash in on the growth of the internet. However, many of these companies were not profitable, and their valuations were based on hype rather than real earnings. In 2000, the dot-com bubble burst, and many internet companies went bankrupt. The collapse of the dot-com bubble triggered a recession, which led to a decline in economic growth and rising unemployment. Causes of the 2001 stock market crash. The 2001 stock market crash was not caused solely by the dot-com bubble. There were several other factors at play, including 9/11 attacks. The terrorist attacks on 11 September 2001 had a significant impact on the stock market. The attacks caused widespread panic and uncertainty, and many investors sold their stocks in response. The New York Stock Exchange, NYSE, was closed for several days following the attacks, and when it reopened, it experienced a significant drop in value. Corporate scandals. Several high-profile corporate scandals, such as the Enron scandal, had a negative impact on investor confidence. These scandals exposed widespread corruption and fraud in corporate America, leading to a loss of trust in the stock market. Overvaluation of stocks. Similar to the dot-com bubble, many stocks in the early 2000s were overvalued, with their prices not reflecting their true value. This meant that when the market corrected, the prices of these stocks dropped dramatically. Consequences of the 2001 stock market crash. The 2001 stock market crash had far-reaching consequences, affecting not only investors but also businesses and the economy as a whole. Some of the consequences include losses for investors. Many investors lost a significant amount of money during the 2001 stock market crash. Some investors lost their life savings, while others lost their retirement funds. This had a devastating impact on many people's financial well-being. Bankruptcies and layoffs. The recession that followed the 2001 stock market crash led to widespread bankruptcies and layoffs. Many businesses were forced to close their doors, while others had to downsize to stay afloat. This resulted in a rise in unemployment and a decline in economic growth. Regulatory changes. The 2001 stock market crash led to regulatory changes in the financial industry. The Sarbanes-Oxley Act, which was passed in 2002, increased the transparency and accountability of publicly traded companies. This act was designed to prevent corporate fraud and restore investor confidence in the stock market. Lessons learned. The 2001 stock market crash taught us several important lessons. Some of these include: don't invest based on hype. Investing in stocks based on hype and speculation is a recipe for disaster. It is important to invest in companies that have real earnings and a solid business model. Diversify your portfolio. Diversification is key to reducing the risk of investment losses. It is important to have a well-diversified portfolio that includes a mix of stocks, bonds, and other assets. Be prepared for market corrections. Market corrections are a normal part of the stock market cycle. It is important to be prepared for these corrections and to have a plan in place for how to respond. Be patient. Investing is a long-term game. it is important to be patient and not to panic when the market experiences downturns. The market will eventually recover, and those who stay invested will benefit in the long run. Conclusion. The 2001 stock market crash was a significant event in the history of the stock market. It was caused by a combination of factors, including the dot-com bubble, the 9/11 attacks, and corporate scandals. The consequences of the crash were far-reaching, affecting investors, businesses, and the economy as a whole. However, the crash also taught us important lessons about investing, including the importance of diversification and being prepared for market corrections. As we move forward, it is important to remember these lessons and to continue to invest wisely for the long term.